Now friends, come to this particular question number 2. Okay, now very good question, but as I already explained that I will extend the scope of each and every question here for better understanding. Okay, now see, this is a partnership firm first of all. Okay, and it is in the second year of its operation. The second year of the operation basically gives you 100% deduction, because first 5 years is 100% deduction, then 5 years, then 5 years. Now ideally this particular question is little bit inferior in the sense that, see, logically I will tell you why this is inferior question, but if you want you can change this particular question to an assumption. Okay, it should have commenced on or after 2006 but before 2021. Okay, so logically it should be in some third, fourth year or something like that, but it's okay. Basically it is in the first 5 years, let's put it like that. Okay, so let's simplify this issue, otherwise we don't want to challenge the question. Okay, so it is eligible for the purpose of 100% deduction. Okay, now first of all the basic computation. Okay, the profits of the business that is provided to us is how much? Is 10 lakhs. Okay, to this we will have to do this headless depreciation calculation. Okay, so the book depreciation add and the tax depreciation, because tax is on a WDV, book here it is on SLM basis. So book depreciation is 3 lakhs. Okay, that you have to add. Now you are in the second year of the operation, you have to calculate the what should I say, the cost and then the WDV. Okay, so if it is 15% 3 lakhs, so the cost of your this machinery is going to be 20 lakhs, because 15% is 3 lakhs, 100% will be 20 lakhs. Okay, so the first year depreciation 15%, let's say that it is 3 lakhs. Now we are not complicating with additional depreciation and these and that and all that kind of situation, because it's a simplified question. So let's keep it simple. Okay, 17 lakhs. Okay, and on that again you calculate 15%. Okay, I think you will get 2 lakh 25, 55, whatever that you get. Okay, so that will be your depreciation. Okay, the tax depreciation. You will get your income after doing business income adjustments. Okay, now the turnover. The total turnover is already given to you as 1 crore and the export is given to you as 80 lakhs. Okay, however, out of this 80 lakhs, 5 lakhs you are difficult because of the insolvency of the realization of that particular net sales. Okay, so the person to whom you have already exported, that person has turned insolvent, so you are not able to get 5 lakhs. Now here you can debate that it is a genuine reason you are not able to bring in the foreign exchange and all that, but the interpretation is very simple, that you should bring in within a period of 6 months or such extended period as the case may be. So if you do not bring in the foreign currency, then it will not be regarded as a part of the export turnover. So 80 lakhs minus 5 lakhs adjustment. Okay, so your turnover is going to be 75 lakhs. Okay, and your total turnover is already given to you as 1 crore. So it will be 75, 1 crore. Okay, this will be your turnover proportion, multiply with this particular income and get the amount of section 10 AA. Okay, as simple as that. And just now it's a pure calculator work, multiply and get the amount of section 10 AA and the net total income. Okay, this is as simple as that. Okay, however, because it is a partnership firm now, it can also be subjected to the alternate minimum tax. Okay, because 10 AA is straight away covered by alternate minimum tax. See, this alternate minimum tax provision I have already kept in mind. Okay, see, this chapter of this is alternate minimum tax. Okay, I have kept the barrack in this particular chapter. Now here, see, if you are claiming section 10 AA, then alternate minimum tax chapter can be applicable in the situation. Okay, so you are a partnership firm, alternate minimum tax is applicable to all the entities other than corporate entities. Okay, however, this is a limit of this 20 lakhs of rupees, but this limit of 20 lakhs of rupees of the adjusted total income, that means the small cases are outside the purview of these AMT provisions, is not applicable to the partnership firms, because this is applicable only to individual, HUFs, AOP, BOI or other artificial persons. Okay, this is not applicable to the partnership firm. So partnership firm, by whatever amount, if you are claiming these deductions, then this particular chapter can be applicable. So already know the total income, plus you will do the adjustments. Okay, then you will get the adjusted total income, and to that you will multiply the rate of the AMT, and accordingly you will compare the tax liability or normal tax liability or the AMT tax liability, and then take the decision. Whichever is higher will be subjected to the tax obligations by the partnership firm.